The global tech rout deepening today. The semiconductor ETFs, SMH, posting its worst week since March 2020. The NASDAQ 100 having its worst week in 2 years. Names like Broadcom, Tesla, Nvidia, and Alphabet all taking a beating today and this week. Our next guest sounded the alarm on some of the big tech stocks back in July. And joining us now is Dan Niles, Niles Investment Management founder and portfolio manager. Dan, happy Friday. So on the S&P, we're back to where we were in mid-June, right before you issued that warning, where at the time we had been led higher, and we were being led higher by technology. Only this time, we're led lower by technology. Aside from that, what's different? Why might we not reverse course and go higher again?
Because I think it's becoming clear to investors that you're spending a ton of money on AI, and despite what people say, the facts are that even though spending on AI is going up, your revenue forecasts are going down. And what I mean by that is if you look at the three biggest hyperscalers and three of the biggest stocks in the S&P 500, which is Microsoft, Google, and Amazon, all three of those companies, when they reported their quarters, even though they upped the amount that they were going to be spending on AI infrastructure, the forward revenue figures for all three of those went down. So at a certain point, John, you're spending a lot of money, but you're going to want to see a return. And by the way, we saw this already post-COVID, where if you remember during COVID, and Nvidia is going to come up, so I might as well bring it up. Nvidia went from negative year-over-year revenue growth before COVID. COVID hit. Revenue growth then in early 2022 went to up over 80% year over year. Then, as you probably remember, there was this COVID hangover. Demand started to slow down. Those three big hyperscalers started to slow their spending, and NVIDIA's revenues by the end of 2022 went from up over 80% to down over 20%. Mm-hmm. And the stock went down 66% as you went through that digestion phase.
But Dan, pushing back on some of what you're saying, okay, early 2000s, 20 years ago, Amazon got punished during that period because all this logistics spend wasn't translating into revenue like some people hoped, right? But if you had been patient, let's separate the investors from the traders here. Amazon's investments really did pay off. Why is AI any different?
Well, you got to remember, there's the short term and the long term, and what you're failing to bring up to investors is that Amazon stock went down about 95% from peak to trough. So if you want to suffer through that, I personally don't. That's fine. But you have to remember, when I got negative on tech stocks in 2000, I would have never in a million years thought the NASDAQ would have gone down 78% from peak to trough over 2.5 years. And so if you look at this AI spend, it's been much more rapid than what we saw during the internet infrastructure build out, in the sense that if you take the launch of Netscape Navigator at the end of 94, and you look at Cisco and where their revenues were 7 quarters out, their revenues were up 3x in 7 quarters. Nvidia's revenues since the launch of ChatGPT at the end of 2022, their revenues aren't up 3x, they're up 5x. So this build-out's been a lot faster, and now you're starting to see, much like post-COVID, when things started to slow down at the big internet companies that were spending on all that infrastructure, you're starting to see the same thing, where the forward numbers are starting to come lower. And so, you're bringing up Amazon, but you're not bringing up the 5,000 internet companies that went to zero. Also, during that period, it's not 5,000, sorry, 1,000 or so internet companies that went to zero during that meltdown. And there's been a ton of AI-related companies that have been formed by the VC community, and there's going to be an Amazon among them. Yeah. But there's also going to be a lot of train wreckage as well.
Yeah, and arguably, particularly on the private side, and where venture capital investments are concerned, and I know some of the longstanding investors in that world have been ringing some of the alarm bells about it. I mean, what you're talking about is what Gartner calls the trough of disillusionment, which is when early excitement about a new technology wanes. You can make that argument about investors and how they're thinking about AI right now. So if you're not looking to invest there yourself and you're steering clear or taking some profit, where are you putting money to work right now, especially as we do have these conversations about rotation and other parts of the market amid the Fed cutting looking more attractive?
Well, two things, Morgan, and I want to be clear about this, is that I still believe you have a lot of room to spend. And so going back to the Cisco analogy, 7 quarters in, their revenues were up 3x. By the time it finished, at 6 years after the end of 1994, their revenues peaked at up 15.5 times. And the stock was up 4,000% over that period of time. So what I'm saying is that in the short term, I think you've got a digestion phase that you just have to go through. I firmly believe in the next several years that Nvidia's revenues will again be able to double from current levels, and the stock will be able to double as well. But I lived through 01, 02. These things can go on longer than you ever imagined possible. So you want to think through that. Now, to answer your other question, I've also been saying since early July, I'm trying to look at areas outside of tech to put money in, and areas that are going to benefit from rate cuts. And so what is that? That's consumer staples. It's areas like utilities, telecom services. And so we own a basket of S&P 500 equal weighted type names in there. And if you look at since July 16th, when the S&P peaked out, the S&P is down about 5% or so. The equal weighted S&P, though, is down about 70 basis points. Mm-hmm. And that compares against the Magnificent Seven that's down, I think it's like 11% or so since then. And so I think investors need to think, well, where's the wind at my sails? We're definitely getting rate cuts. The question now is it 3 or 4 between now and the end of the year? We're going to get more next year. And I personally don't think we're going into a recession, by the way, because you've still got more job openings than people unemployed. And in a services-led economy, it's hard to see how you end up with a recession in that environment. Yeah. And so that's kind of where I'm looking. And I did cover some of my AI-related shorts at the end of the day today, because some of them were getting oversold. It's never a straight line down. You're going to get some rallies. And so I took some of those, those positions off.